Today's market focus: the Fed isn't promising rate cuts. Funds within the market continue to shift and reposition. AI is kicking off a hardcore elimination round. Could it be that the biggest risk is actually hiding in so-called safe positions? Thursday, January 29th, BitcoinTV Chinese channel. Where is the blockchain? I'm Michael. Let's first take a look at the most important data headlines from the crypto world in the past 24 hours. This time, at the FOMC meeting on January 28th Eastern Time, it was the same old formula. They announced that interest rates would remain unchanged at 3.75%. The tone was neutral, meaning the economy is still holding up. Employment is okay, inflation is a bit high, but for now, do not expect any immediate liquidity easing. For Bitcoin, the FOMC acts more like a mirror reflecting your positions, rather than a steering wheel telling you which direction to go. Looking back at 2025, when interest rates stayed unchanged, the market mostly just fluctuated slightly. In contrast, after the rate cut meetings in September, October, and December, prices actually saw pullbacks of 6% and even 8%. In other words, whether the market moves or not mainly depends on how tight positions are before the meeting. Before the meeting, when everyone's expectations are aligned, SOPR hovers around 1, leverage and open interest keep piling up, and volatility gets suppressed to very low levels. Once the meeting ends and there's no new narrative, it's easy for the market to first deleverage, then go after profits. On-chain and derivatives data also show that after the FOMC, what's common is increased volume, widening spreads, and faster price reactions. More like clearing out positions than directly shifting the trend. In the next 30 days, the focus isn't on what the Fed says, but rather on whether leverage will decrease, selling pressure will ease, and liquidity can gradually recover. There's a common saying in the market that whenever Bitcoin pulls back, the money gets freed up and flows into gold. But looking at the on-chain money flow structure, this logic doesn't hold up. Looking at the stablecoin supply ratio, SSR, it has already dropped from the previously crowded level of 18 or 19 down to 12.57, which falls right into the wait-and-see range of 10 to 15. This suggests that funds are shifting from having already entered the market to waiting for direction, rather than leaving the crypto market altogether. Meanwhile, the price of Bitcoin is still holding steady around $89,000 without the kind of sharp drop you'd expect if liquidity were being pulled out. If funds were really fleeing, the price would have collapsed long ago. The strength in gold is more in line with institutions diversifying their assets by going long. Stocks, precious metals, digital assets, and stablecoins are often allocated together. What's being adjusted is the risk exposure, not simply swapping Bitcoin for gold. Based on the current data, it looks more like the market is waiting for direction rather than running away. Bitcoin keeps hitting resistance at $92,000, but the money on-chain is anything but quiet. The 30-day moving average of active USDT addresses has soared to around 300,000, hitting a new high, yet the price has not budged at all. The problem isn't that there's less money, it's that the money is moving around. Looking at the continued net outflow of stablecoins from exchanges, it seems more like people are withdrawing their funds from HKEX and parking them in self-custody wallets, or DeFi to cool off for a bit, rather than rushing in to buy coins right away. The money isn't being converted to fiat and fleeing, nor is it being used to buy the dip or chase the rally in a hurry. Instead, it's staying on-chain in the form of USDT, earning some yield on DEX and maybe rebalancing portfolios along the way. Right now, the funds are still in the market. They're just sitting in the stands, waiting for the next whistle to start the game. Please like and turn on the notification bell. We'll be monitoring news updates for you around the clock. Our channel takes a macro perspective, providing in-depth integration in just 15 minutes to help you quickly grasp major changes in the digital asset space and enhance your understanding. Looking at the news, the reason risk assets have managed to hold up this year isn't because the economy has suddenly improved, but because everyone still believes that liquidity will eventually return. US stocks remain expensive, Bitcoin is holding up, and gold is hitting new highs. In fact, they're all telling the same story. The market assumes that the Federal Reserve will have to cut rates again sooner or later, and may even have to inject more liquidity to cope with the pressures of deficits, debt, and a gradually slowing economy. As soon as this expectation wavers, the market will be the first to react, and the money will be the first to leave. That's also why every time the Federal Reserve speaks now, the market gets especially nervous, not because it hears something new, but because the answers it wants aren't there.
The U.S. Federal Reserve has concluded its first Federal Open Market Committee meeting of the year, deciding to keep the federal funds rate target range unchanged at 3.5% to 3.75%, officially pausing the previous cycle of consecutive rate cuts. Federal Reserve Chairman Jerome Powell stated after the meeting that the fundamentals of the U.S. economy remain resilient, but inflation has not yet fully returned to the policy target. So, at this stage, there is no urgent need for further rate cuts.
To proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance.
After the latest statement from the Federal Reserve, Bitcoin briefly fell below $88,500 in the early morning, hitting a low of $87,200, but then quickly rebounded and returned to $89,000, forming a classic V-shaped pattern. This indicates that short-term buying support remains, but volatility has clearly increased. Ethereum's performance was relatively weak, falling below the $3,000 mark, while a major whale took profits by selling about 10,000 Ethereum at high levels.
This time, Powell basically laid his cards on the table. He's not promising a rate cut, nor is he providing a roadmap. Right now, he's deliberately avoiding those topics, essentially patching things up to keep high interest rates around a bit longer. But everyone should be clear, he may not be able to stick to this path until the end. With Trump coming to power, Treasury Secretary Bessent has already announced that the next Fed chair nominee will be revealed within a week. When the transition period comes in February or March, will the new leader continue to be hawkish, or will they loosen policy early to coordinate with fiscal measures? Right now, no one really knows for sure. So for major funds, the most practical choice right now isn't to bet on a direction, but to quickly unwind leverage and pull back, waiting for a clear signal. This kind of uncertainty will definitely dampen the momentum of assets like Bitcoin in the short term. But if we look at the bigger cycle, as long as rate cuts are inevitable sooner or later, that anchor is still there. To put it plainly, all this turmoil right now is just about repricing the next market cycle. AI hasn't cooled off at all. It's just shifted from a lively scene to a hardcore elimination round. The sense of surprise brought by new models is fading, but the bills for computing power, electricity, and talent are only getting higher and higher. The barriers to entry are being raised bit by bit, and the focus of competition has quietly shifted. It's no longer about whose model is smarter, but about who can make their business work in the long run while burning cash and still manage to sustain themselves. At this stage, capital is no longer chasing short-term hits, but instead is starting to pick players who can build a complete ecosystem and have a chance to survive until the end, getting in line early.
The latest news says that SoftBank is in talks to invest an additional $30 billion in OpenAI, continuing to bet on its AI infrastructure and positioning. At the same time, OpenAI is considering introducing real-person identity verification mechanisms, including WorldCoin's Orb iris scanning solution, which drove a surge in WLD early in the morning, with the price jumping from about 46 cents to 64 cents, a maximum increase of over 40% within 3 hours.
They can be a for-profit business, but what they're becoming is a public benefit corporation. Basically, the whole raison d'etre of OpenAI was to build artificial general intelligence, but for the good of humanity.
In addition, Nvidia, Microsoft, and Amazon are in talks to invest in OpenAI, with the total amount potentially reaching as much as $60 billion. Among them, Microsoft plans to invest less than $10 billion. Amazon intends to contribute more than $10 billion, and Nvidia's investment could be as high as $30 billion. Before this round of financing, OpenAI's valuation may rise to $730 billion.
The current AI industry is no longer an era where fresh concepts can easily attract funding. It's now a life or death battle where the giants are stepping in to stake their claims. Nvidia, Microsoft, and Amazon are all injecting capital into OpenAI, especially Jensen Huang. That potential $30 billion may look like an investment, but in reality, it's turning future chip profits directly into equity, locking down the ecosystem in advance. The barriers to entry are sky high now, and smaller projects barely even have a chance to get a seat at the table. Looking at OpenAI's evaluation, by using WorldCoin's Orb iris scanning, they're essentially turning WLD from a marginal token into a digital ID for the AGI era. This isn't just about pumping the price, it's about giving digital assets a legitimate role. The bigger picture is that, faced with interest rate uncertainties, capital is frantically pouring into AI infrastructure, basically exchanging fiat for the most solid tech assets. In the future, only those projects that can serve as plugins for the giants will survive. The rest will vanish as soon as the bubble bursts. The key to watching this play out boils down to one question: who's got that ticket to board the ship? With just one comment from Kathy Wood, CZ's image collapsed. Bitcoin pulled back. Honestly, Binance is to blame. As the exchange competition heats up, can Coinbase's strategy withstand the market shakeout? The market's been dragging on for so long that everyone's nerves are stretched thin. Lately, just scrolling through crypto Twitter, you can sense something's off. The tension is at its peak, with both familiar faces and new accounts jumping in to argue. At the end of the day, this isn't just a sudden uproar. It's the old grudge from what's known as the October 11th incident resurfacing, and Binance along with CZ are being thrown back into the fire. CZ used to be the undisputed top dog in the crypto world, his reputation rock solid, but now he's become the main target under attack. KOLs are slapping labels on him, criticism is everywhere, and all the goodwill he built up in the past has basically been wiped out in one go. The real point of interest is how this wave of public opinion actually caught fire.
The starting point of this media storm came from Cathie Wood's public statement on a show where she directly attributed Bitcoin's recent pullback to the October 10th Binance system anomaly that triggered a deleveraging event.
As we assess the ecosystem right now, over the past 2 to 3 months, we've been experiencing the aftershocks of what happened on 10/10. So 10/10, October 10th, in the crypto world, I'm not sure if this has been discussed more broadly, was the flash crash caused by a software glitch on Binance, which deleveraged the system to the tune of $28 billion.
This caused the total market cap to evaporate by $500 billion, with liquidations over $19 billion, making it one of the most severe liquidation incidents in history.
This viewpoint quickly spread throughout the English-speaking crypto community, with many KOLs directing their criticism at Binance founder Changpeng Zhao, questioning the abnormal liquidation mechanism, the post-event modification of candlestick charts, and the lack of a full investigation report or official explanation. Subsequently, the public outcry spread to Chinese-speaking communities, with several major crypto influencers speaking out one after another.
After the incident, although He Yi came forward to say that Cathie Wood didn't understand the real situation, this evasive explanation did nothing to quell the anger. Even HKEX founder Shu couldn't stand it and publicly criticized Binance for shirking responsibility.
In my view, this wave of public opinion is actually a collective act of venting and sulking by retail investors amid a sluggish market. You really can't blame Cathie Wood for this, nor is it fair to simply pin it all on Binance or Changpeng Zhao with a single sentence. Cathie Wood is merely laying out risks that might otherwise be overlooked, while a platform like Binance, which prioritizes efficiency and is highly centralized, naturally amplifies shocks during extreme market conditions. What's truly contradictory is the mindset of retail investors. They enjoy the liquidity and leverage provided by centralized platforms, yet when the market turns, they demand absolute fairness and zero accountability. When things are going well, everyone turns a blind eye to system flaws. But as soon as there's a downturn, people rush to find someone to blame. So structural issues end up being criticized as personal failings. This isn't about someone saying the wrong thing. It's the emotional cycle that plays out in the market again and again under high leverage and high concentration. When it comes to major players in the crypto world, you can't ignore Coinbase. Its current situation mirrors the entire market. When the tide goes out, you can clearly see who's been swimming naked. In the past few years, when the market was good, exchanges could make money effortlessly as long as they had enough traffic and listed coins quickly. But things are different now. Users are more selective, regulations are stricter, and transaction fees alone are no longer enough to keep things afloat. Looking at the external environment, gold is hitting new highs, Bitcoin is fluctuating at high levels, and stablecoins have instead become an essential need for cross-border transfers and fund management. The market is shifting from hype-driven speculation back to focusing on structure, and it's clear that Coinbase doesn't want to just be a simple coin trading booth anymore. The question is, how does it plan to transform itself next?
That's why for the last 13 years, we've been relentlessly updating the system so anyone can achieve economic freedom. Coinbase builds products to help individuals, businesses, financial institutions, and governments. We've also built a developer platform to make crypto integration effortless for any company.
In this round of strategic planning, Coinbase is advancing multiple business lines simultaneously. On one hand, it is testing the USDF stablecoin and collaborating with Flipcash to launch customized enterprise solutions, using USDC as collateral to cover scenarios such as payroll and cross-border payments, which are expected to go live this year. The stablecoin business has already become a core source of revenue. In the fourth quarter of 2025 alone, quarterly revenue was approximately $247 million. On the other hand, the launch of precious metals futures covers gold, silver, copper, and platinum using a cash settlement model. At the same time, Coinbase has partnered with Kelsey to launch prediction markets across all 50 states in the US, clearly leveraging supernodes to drive traffic.
If you look at all these moves together, you'll see that Coinbase isn't just playing randomly. It's actually switched to a whole new track. They've shifted from relying on transaction fees to aiming to become an all-around provider of financial infrastructure. This path is clearly more challenging, but the potential ceiling is also much higher. The problem is, the further they go, the more obstacles they encounter. Prediction markets will run into gambling regulations, and stablecoins will touch on issues of financial sovereignty. Recently, in the UK, their ads were banned for downplaying risks and implying that crypto could help ease the cost of living. In the short term, all of this will slow things down and stir up controversy. But in the long run, it's never the most aggressive players who last. It's those who can truly make their products work within regulatory frameworks. How far Coinbase can go will ultimately be determined by time.
Coinbase CEO Brian Armstrong announced that, following the Trump accounts plan, employees' children can receive a $1,000 subsidy from the U.S. Treasury, and the company will match that amount directly. He also casually floated an even more radical idea. It would be best to give the next generation their first assets directly in Bitcoin, starting on-chain. Although the multi-chain token launch platform Flip is exclusively favored by Binance Web3 wallet, its strength lies in more than just token launches. Its foundation is solid. It has built a reusable underlying framework, with rules set in advance and tax revenue providing sustainability. From the very beginning, projects have access to long-term resources, whether they're meme coins, games, or social platforms, allowing them to focus on building products rather than just betting on the initial launch hype. Currently, Flip is already running on multiple blockchains, such as BNB, Xlayer, Monad, and Morph, with a very clear multi-chain strategy. Meta has directly raised its capital expenditure forecast for 2026 to between $115 billion and $135 billion, which is significantly higher than the $110 billion the market was previously watching. The message is clear: they're not cutting costs. Investment will keep increasing. Tesla has officially decided to invest $2 billion in CEO Elon Musk's AI company, XAI, doubling down on AI while still keeping its main business on track. The CyberHub Robotaxi project is proceeding as usual this year, which shows that AI is a long-term direction. But car manufacturing and autonomous driving can't be put on hold either. Recently, the total value of tokenized gold and silver has surpassed $6 billion, reaching about $6.295 billion and continuously hitting new highs. Among them, gold is carrying the banner alone, with a market value of about $5.814 billion, while silver is relatively smaller at around $481 million. When it comes to putting precious metals on the blockchain, gold is clearly calling the shots.
Many people in the crypto world end up losing everything, not because they bought some obscure meme coin, but precisely because of that position they thought was the safest. You think it's a value investment, you see it as an industry benchmark, so you're willing to go all in, confident enough to turn off your phone and sleep soundly at night. But you need to understand, in the cutthroat world of crypto, risk is never equal to volatility. Risk is actually inversely proportional to your level of vigilance. When you feel completely at ease with a position, you've already surrendered your defenses, even extinguishing any thought of setting a stop loss. What the market makers and the market itself love to do most is quietly pull the rug out from under you when you're at your most comfortable and least guarded. Whether it's Bitcoin or Ethereum, the moment you fall into the illusion of absolute stability, that's when your cognitive blind spot begins to form. In this space, the position you trust the most is always the one that ends up costing you the most. A true hunter never seeks a good night's sleep. What he seeks is to be the only one with his eyes open when risk arrives. That's the in-depth breakdown for this episode. Our channel is always focused on the core narratives and value discovery in the digital asset space. If you agree with our logic, feel free to stay updated with the latest news and enable real-time notifications. If you want access to higher-level research reports, you can follow our advanced channel. From Monday to Friday, I share my personal in-depth reviews of market cycles, capturing opportunities with certainty amid the trends. See you tomorrow.